Welcome to the Data Dawning, where the data speaks. We listen. It's time to unlock the numbers and decode the story. Okay, let's jump right into this deep dive. We've got a substantial stack of sources to unpack today. We're covering everything from recent shifts in the financial markets, key economic data, to rising geopolitical tensions and their impact on specific asset classes.
That's right. And we've pulled insights from various Yahoo Finance segments, asking for a trend, discussions around those Israel-Iran tensions, analysis on the oil prices jump segment. Plus, we're weaving in the detailed perspectives from Mark Meldrum, Darius Dale over at 42 Macro, and commentary from, well, a whole range of other expert guests featured in the material.
And our mission here, it's pretty crucial, right? To cut through all this information, all this noise, and really extract the most vital nuggets of knowledge and insight for you, our listener. We want to highlight the different viewpoints, sometimes conflicting ones, that are presented in these sources and help you understand what the data is really saying in this, well, pretty complex environment.
Absolutely. Ultimately, by exploring these different angles and data points, we aim to provide you with some context for the forces that are currently shaping your financial world. And maybe, just maybe, inform your perspective on potential investment decisions.
Okay, so let's start by taking the pulse of the market. What happened over the past week or so? Looking at that Yahoo Finance asking for a trend segment, there was definitely a period recently where stocks were actively rallying.
Yes, that segment specifically noted Wall Street seeing green. There was a boost coming from the tech sector, too. They highlighted solid performance from Oracle, for instance.
Right.
And on one particular day covered in the sources, all the major indices actually closed higher.
And this wasn't just a small bounce, was it? The S&P 500, I think it hit its highest level since February 20th.
That's right. And that came just one day after reaching its last record high on February 19th. So yeah, the market was really pushing, getting very, very close to those all-time record levels again.
But what's fascinating here is how quickly that momentum just evaporated, wasn't it?
It really was. The Yahoo Finance segment, focusing on the Israel-Iran tensions, pointed out that this sudden jump in geopolitical risk, it immediately hit stocks hard. It caused U.S. stocks to slide pretty quickly and prompted investors to, shift towards a de-risking posture, pull back a bit.
So you had this market building serious upward momentum, seemed like it was shrugging off some concerns, almost back to record highs.
Right.
And then, boom, this geopolitical event essentially just stopped that whole upward trajectory dead in its tracks.
Precisely. It just underscores how quickly global events can impact market sentiment and positioning. However, and this is interesting, despite that sharp reaction to the geopolitical news, Michael Rinking, who was featured via Yahoo Finance, he made a really interesting observation. He noted that for the entire week, despite all that volatility, up and down, the S&P 500 was essentially unchanged, flat. He described the net move as pretty muted.
That's quite a contrast, isn't it? A strong rally, halted by a geopolitical shock, yet the weekend's flat. What does that suggest about where the market's head is at right now?
Well, Rinking's interpretation is that it suggests a market that perhaps had previously been, let's say, overweighting the good news, pushing it towards those highs, but is now reacting more significantly when bad news hits. However, the fact that the net change was muted could also imply maybe a degree of restraint in that reaction so far.
Or maybe just conflicting forces canceling each other out.
That's possible, too. It's this kind of push and pull, where negative catalysts have a clear immediate impact, but maybe the underlying bullishness or just a lack of widespread panic prevents a deeper sell-off, at least for now.
Okay, right. Let's unpack some of the economic data that came out this week then, because some of it seems to be sending signals that might, well, contrast a bit with the market pushing for highs or the inflation worries we keep hearing about.
Yeah, they bring
Weekly claims data, for example. That's something economists watch really closely for signs of a slowdown, right?
Absolutely. And the number of continuing jobless claims, so that's people who've filed for unemployment but haven't found a new job yet, that number moved up this week.
How much?
It actually reached its highest level since November 2021, over 1.9 million claims.
Wow, okay. That seems like a pretty significant number.
Right.
What does that specific data point tell you? What's the story there?
Well, it tells a pretty clear story about the labor market, really. It's taking longer for people who lose their jobs to find new employment.
Okay.
And that indicates that overall hiring activity is slowing down. It's not necessarily a sign of, massive layoffs spiking up suddenly,
Here I am.
but more a cooling in the pace at which people are getting back into the workforce.
So it's not exactly screaming recession, but it's definitely a shift in the dynamics we're seeing. How are analysts viewing this?
Josh Schaefer, in that Yahoo Finance segment, he put it quite well, I thought. He said this labor market data isn't yet screaming for the Federal Reserve to jump in and cut interest rates. However, he and also Neil Dutto of Renaissance Macro pointed this out too, sees the rate of change, the fact that these continuing claims are moving higher, as a yellow sign.
A yellow sign, not a red flag yet.
Exactly. Not a red flag indicating immediate crisis, but it's definitely something crucial to watch. Why? Because, well, a sustained increase in continuing claims like this, it could precede a higher overall unemployment rate down the line.
Okay, so a cautious signal from the labor market, suggesting things might be cooling off a bit. Now let's turn to inflation data, because Mark Meldrum provided some really detailed analysis here, and it presented a potentially very different picture than the popular narrative we often hear.
Yeah, his take was quite striking. He specifically highlighted that both the Consumer Price Index, CPI, and the Producer Price Index, PPI, have shown, well, surprisingly benign readings over the last 4 months.
Benign might even be putting it mildly, based on the numbers he detailed. He pointed out that the annualized rate for both headline CPI and even the super core CPI.
Right, the one that strips out housing too.
Exactly. That over the last 4 months is actually right at the Fed's 2% target.
Yeah, and drilling into the month-over-month figures, which can capture the more recent trends, headline CPI was just 0.075%.
Tiny.
Annualized, that's only 0.9%, like less than half the Fed's target. Year over year, it's still 2.4%. And core CPI, removing just food and energy, was 0.13% month over month, or 1.57% annualized. The year over year there is 2.8%.
But that super core reading, the one taking out housing costs, that's the one that really seemed to grab Meldrum's attention, wasn't it?
Absolutely. That measure was just 0.03% month over month annualized, a minuscule 0.37%. And year over year, it's 1.85%, so already below the Fed's 2% target. Based on that specific reading, Meldrum's interpretation, his exact words were that we are currently flirting with deflation, or at least soon you'll be flirting with deflation.
Flirting with deflation. I mean, that's a pretty provocative statement when so many discussions are still focused on sticky, persistent inflation. And he said the PPI data looks similar, the producer prices.
Yes, he noted the PPI figures also showed 4 consecutive months of these benign numbers. Final demand goods up just 0.2%, services up 0.1%, goods less food and energy also just 0.2% month over month, consistent cooling.
So really consistent signals of cooling prices, especially when you look at these core measures and the recent trend. Meldrum also mentioned that the May data, the numbers we're looking at now, they already reflect some existing tariffs.
That's correct. So the current numbers already bake in the impact of existing policies, like that general 10% tariff and the 25% tariffs on specific imports, like aluminum, steel, and non-USMCA autos.
Interesting. What about the impact of something massive, like artificial intelligence, AI, on prices? Is that starting to show up in these numbers yet, do we think?
Mark Meldrum believes it's probably too early to see the direct effects of AI clearly in these big price indices. However, he holds a very strong conviction that AI is going to be massively deflationary in the coming years.
Why? What's the mechanism there?
His argument is really rooted in productivity. AI enhances productivity, potentially dramatically, right? Which lowers the cost of producing goods and services per unit. And in a competitive market, low unit costs should eventually translate to lower prices for consumers.
So you've got current inflation readings that are already quite low, hinting at disinflation.
Yeah.
And Meldrum is basically arguing there's this huge deflationary force from AI that hasn't even fully hit the system yet. That seems like a really powerful combination.
It does, and he actually sees evidence of AI's impact already starting to appear in other places, specifically the job market.
Or like how so?
He referenced an Oxford economics briefing, I think it was titled, "Educated but Unemployed." This report, he noted, shows signs that entry-level positions are being displaced by AI at increasingly higher rates, especially roles that heavily involve what's described as declarative, conceptual, and procedural knowledge.
So basically jobs that involve processing information and following defined steps.
Pretty much, yeah. So AI isn't just changing how some jobs are done, it's potentially eliminating others, particularly at that entry level.
And Meldrum connects this back to the deflation argument.
He does, by highlighting business efficiency. Businesses are driven by the bottom line, right? Managers whose performance is tied to cost reduction will naturally leverage tools like AI to lower expenses. And that can include reducing the need for certain types of labor, which ultimately feeds into that deflationary pressure.
That really paints a picture of a potential deflationary wave building, not just from current economic cooling, but from a fundamental technological shift.
Exactly. It's another layer of complexity here, and one that definitely runs counter to that persistent inflation narrative we hear so much about.
Really fascinating contrast. Hey, if you're finding this breakdown valuable, drop a like and share.
Yeah, definitely.
Now let's pivot dramatically because while we're talking about economic data and potential deflation, global events this week have been, well, significant, particularly the escalation of the conflict in the Middle East.
This certainly grabbed headlines and definitely moved markets. The Yahoo Finance source reported on Israel launching an attack targeting Iran's nuclear program and also its military leadership. That was followed by retaliatory missile strikes from Iran against Israel.
And Darius Dale from 42 Macro, he provided some more specific details on this, didn't he?
He did. He detailed that on Friday, Israel conducted a really sweeping air campaign, involved something like 200 jets hitting 100 targets across Iran. He also noted that Iranian state media confirmed that high-ranking IRGC officials were killed in these strikes. Dale also highlighted that Israeli Prime Minister Benjamin Netanyahu vowed to continue these strikes for, quote, as long as it takes.
And Dale also pointed out the U.S. angle here.
Yes, he noted that President Trump signaled the U.S. commitment to supporting Israel in this conflict, which, from Dale's perspective, increases the risk of the U.S. being drawn into another prolonged military engagement in the region.
Mark Meldrum, though, he offered a specific take on this escalation, kind of viewing it through a historical lens, right?
He did. He noted that Israel has actually conducted strikes against Iran before, even under the Biden administration, without triggering such a significant retaliatory response or, widespread escalation. His read on it is that this latest flare-up is an event, not a trend.
An event, not a trend. Why does he characterize it that way? Why not see it as the start of something bigger?
His reasoning is that he believes Iran fundamentally cannot fight a full-scale war against a U.S.-backed Israel. They'd lose. He thinks the clerical leadership in Iran understands this potential outcome, knowing that such a conflict would likely lead to them losing power. However, at the same time, they also can't afford to be perceived as weak, either internally or externally.
So basically, a limited retaliation was necessary to save face, but not one that risked tipping over into full-scale war.
That's his read on it, yeah. He anticipates any further strikes from Iran will be, limited or maybe even weak. He even mentioned the effectiveness of Israel's Iron Dome defense system against missile attacks.
And this interpretation actually influenced his trading.
It did. This specific view, believing this is a temporary event that will likely subside, was actually his basis for taking a tactical shorting position in the market on Thursday night.
Wow, that's a bold call, especially given the immediate intensity of it all. Michael King also noted, via Yahoo Finance, that the timing of Israel's strike was pretty surprising. It happened right before scheduled negotiations were supposed to take place.
Yeah, negotiations which are now, obviously, likely off the table.
Right.
And King also mentioned that the market did start to, quote, sniff this out a little bit before the full escalation happened. Oil prices were up over 5% even before the attack occurred. And earlier in the week, the International Atomic Agency had already flagged some issues with Iran's compliance. So, there were signals, hints of rising tensions before the overt military actions.
Okay, that brings us neatly to the impact on the oil markets, which reacted very swiftly, very sharply to the news.
They certainly did. Fernando Valle, another voice from the Yahoo Finance coverage, reported that oil futures saw their biggest jump in 3 years following these escalations. At one point, oil was up as much as 8%.
How did that sudden spike affect the energy companies themselves?
Well, Valle explained that this gave significant relief to the exploration and production companies, the E&Ps, especially those carrying higher levels of debt. He noted that companies focused purely on, just pulling oil out of the ground benefited more than those with significant refining exposure.
Why is that?
Because the refining segment is actually seen as less positive in this particular scenario. He cited companies like Exxon, Chevron, and BP as having significant refining operations that might not benefit as much from just a crude price spike.
Were analysts anticipating a move like this in oil before the conflict escalated?
Well, Fernando Valle mentioned that Hedgeye, for example, had actually upgraded several E&P names to the long side weeks ago. Companies like Diamondback, Matador, Permian Resources.
Oh, okay.
Though they were already seeing a bullish trend developing in oil prices before this latest escalation, suggesting some underlying upward pressure was already building.
Are there specific U.S. energy companies with assets right there in the region that face particular risks from this conflict?
Yes, Valet highlighted a few. ExxonMobil, for instance, has significant production in Qatar gas in Qatar, which shares that massive North Field gas reservoir with Iran.
Right, and a lot of that has to go through the Strait of Hormuz.
Exactly. Much of the gas exports from that region pass through the Strait of Hormuz, making it very vulnerable to disruptions. Phillips, Shell, Total, they also hold interests in fields in that area. Companies like Occidental Petroleum, Oxy, and Chevron were mentioned as having perhaps less direct exposure to production specifically reliant on passage through the strait.
Okay, now, prognoses for where oil prices might go from here,
Mm-hmm.
they seem to be all over the map, right?
Mm-hmm.
Reflecting the uncertainty.
Wildly different, yeah. Bloomberg Economics, which JP Morgan flagged as a tail risk that could potentially push U.S. CPI inflation as high as 5%, they projected prices could hit $120 a barrel.
Wow.
But then on the other end of the spectrum, some views discussed in the sources suggest that if supply increases materialize or maybe demand falters significantly, prices could potentially fall all the way back towards $40. Big range.
Fernando Valle, though, he seemed pretty skeptical of that really high $120 target.
He was. Valet believes $120 oil is probably unlikely to be sustainable. Why? Because consumers generally just can't afford it at that level, and that high price would significantly crimp demand.
Makes sense.
He also noted that oil prices tend to overshoot during these kinds of geopolitical events. Historically, wars or attacks can sometimes actually present opportunities to sell into that strength because the actual impact on supply chains or overall demand often doesn't last as long as that initial price spike suggests. The tail, as he put it, isn't typically that long.
What about the anticipated OPEC plus supply increases later this year? Wouldn't that help cap prices?
Valet argues that the impact of that anticipated OPEC plus supply surge wouldn't fully offset concerns if the Strait of Hormuz becomes a major flashpoint.
Why not?
Because a substantial amount of the oil production from key players like Saudi Arabia, Kuwait, and the UAE is located on their east coast and must be exported through that strait. So any disruption there is critical, regardless of production quotas elsewhere.
Got it.
He also noted that even with quotas being adjusted, the actual increase in production growth might be more limited than initially expected, maybe around 700,000 to 800,000 barrels a day compared to earlier expectations of a maybe 1.3 million barrel a day unwind of those voluntary cuts.
Mark Meldrum, he raised an even more severe possibility, the potential for a major energy shock.
Yes, he drew a really important distinction between a slow, gradual rise in oil prices over months, which economies can typically absorb, adjust to,
Right.
versus a sudden, rapid, massive price increase. A slow drift from, say, $60 to $100 is one thing, but a quick spike to $100 or higher, that would be a major problem. It creates both economic disruption and feeds significantly into inflation.
And the absolute worst-case scenario mentioned in the sources, what's the nightmare outcome?
Closing the Strait of Hormuz, Meldrum explicitly stated this would be very, very bad. It could cause oil prices to truly skyrocket. He even drew a parallel to the effects of the 1970s Iranian Revolution, suggesting such a shock could lead to a stagflationary scenario.
Ugh, stagflation. That's the worst of both worlds, right? High inflation and stagnant or slowing economic growth.
Exactly, a deeply challenging economic situation. So that's definitely a significant risk factor that's been introduced by this recent escalation.
Okay, so how did markets react in terms of traditional safe havens during all this?
Well, Michael Rinking noted the usual playbook in these kinds of conflicts. Equities tend to move lower, while traditional safe assets like oil and, importantly, gold move higher.
And gold did what it was supposed to do.
It did, yeah. According to Mark Meldrum, gold performed as expected, acting as that safe haven asset.
Darius Dale at 42 Macro mentioned his clients were particularly pleased with their gold position, I recall.
Yes, he highlighted that gold was added to their KISS portfolio way back in October 2024, actually replacing fixed income at the time. And that position is up approximately 30% since then. He reiterated that in this volatile environment, gold is really proving itself to be a truly defensive asset.
Okay, what about Bitcoin? It's often talked about as a potential safe haven, maybe an alternative store of value, especially in times of global uncertainty like this. How did it fare?
Yeah, that's a common narrative, but Mark Meldrum pointed out that Bitcoin did not behave like a safe haven during this recent geopolitical spike. Its price was essentially flat.
Hmm, interesting.
He used this observation to really question the whole narrative around Bitcoin as a store of value or an inflation hedge. He noted it actually declined when inflation initially picked up significantly. So, his conclusion from this latest episode, he sees Bitcoin primarily as just a risky bet.
That certainly challenges a common perception in the crypto space, doesn't it? What about treasury yields? They typically fall when investors seek safety, pushing bond prices up. Did that happen?
This is where we saw a really notable deviation from the typical risk-off playbook, as Michael Ringking observed. Treasury yields were actually moving higher on a risk-off day. That's atypical.
Why would that happen?
He attributed it to the conflicting forces at play. While there's definitely demand for safety, pulling yields down, there's also this growing fear that the conflict itself could impact inflation down the line, pushing yields up.
Darius Dale went even further with his interpretation, didn't he?
He did. He interpreted the rise in nominal treasury yields right across the curve, 2-year, 10-year, 30-year bonds, as an alarming sign of the potential loss of safe haven status for the treasury debt market.
Loss of safe haven status. That's a big statement. What's his reasoning?
His reasoning is that investors are likely looking at the prospect of another U.S. military conflict and immediately thinking about what that means for the U.S.'s already unsustainable fiscal trajectory.
Ah, more government spending, more debt issuance.
Exactly. That concerns bondholders and puts upward pressure on yields. And he broke down the components of the yield increase, noting that a large majority, something like 83%, came from an increase in real yields. Only 17% came from a change in inflation expectations.
And higher real yields point more towards fiscal concerns.
In this context, according to Dale, yes, real yields reflect the return after accounting for inflation. Their increase here, he argues, points strongly to concerns about the U.S. fiscal situation and the sheer amount of debt, rather than just rising inflation fears alone.
Okay, a lot to unpack there. Quick reminder to our listeners, follow us on Twitter @SnippetLabs for more updates as these stories develop.
Got it.
Let's shift gears now and look at some of those broader macro and fiscal dynamics that were highlighted in the sources, specifically trade policy and the U.S. deficit situation.
Right, starting with trade. Darius Dale reported on President Trump's plans to send out letters to trading partners in the next couple of weeks.
What's the purpose of these letters?
The move is apparently intended to unilaterally set tariffs, basically putting countries on notice ahead of that July 9th deadline associated with his previous 90-day pause on taking such actions.
So kind of a proactive step, signaling his intentions early before the deadline hits. Dale also noted that the administration has been pursuing trade deals, but the progress seems limited.
That's right. He characterized the outcome so far as mainly an unsubstantiated framework with the UK, and really just a detente with China that even needed recent negotiations just to sort of repair the relationship. It doesn't sound like widespread, comprehensive trade agreements are really imminent based on his assessment.
Mark Meldrum, he had a particularly colorful take on President Trump's approach to trade policy, didn't he?
He did, yeah. He believes what he calls the taco trade. Trade deals driven purely by economic calculations and mutual benefit is effectively over.
Okay, so what's replacing the taco trade?
In its place, Meldrum sees the rise of the ego trade. His view is that President Trump will pursue tariffs not necessarily for purely economic reasons, but more to project strength, to show he's a tough guy, not a chicken, as Meldrum put it. And Meldrum speculates that this motivation might even lead him to implement tariffs sooner than those stated deadlines.
He didn't seem to think this approach would actually lead to many favorable trade deals for the U.S., though.
No, he really questioned whether President Trump thinks other world leaders can't just coordinate and talk to each other to strategize their responses. Meldrum doesn't anticipate other countries rushing to the negotiating table under these kinds of threats. He believes the ego trade approach will manifest with a vengeance in the coming weeks.
And isn't there a legal challenge underway regarding President Trump's authority to impose tariffs like this?
Yes, Meldrum pointed that out. The court challenge to the president's unilateral tariff powers, it's not scheduled to actually hear arguments until July 31st. So, in Meldrum's view, this gives President Trump plenty of runway to implement new tariffs before any potential legal check on that authority might take place.
Looking at the potential economic consequences of these tariff policies, one source estimated a pretty notable headwind, right?
Yes, analyzing the timing and the potential scope of these tariffs, the sources suggest this could represent about a 1% to maybe 1.5% headwind to overall U.S. economic activity in 2025, and the majority of that impact is expected to be felt within that year.
Okay. Let's turn now to the U.S. fiscal situation, the growing deficits, the national debt. How do the sources view this ongoing challenge?
This is a major, major concern highlighted by Darius Dale at 42 Macro. He used the term illusion of fiscal retrenchment to describe what's happening right now.
Illusion. How so?
Well, he noted that while the calendar year-to-date deficit might appear smaller on the surface, it shrunk by about $464 billion to $1.6 trillion. The fiscal year-to-date deficit, which he argues gives a clearer picture by smoothing out some one-off distortions, that number actually increased by $215 billion to $2 trillion.
So depending on how you slice the numbers, you get a very different story about whether the deficit is shrinking or growing.
Exactly. And he used Treasury Secretary Bessent's evolving deficit targets to kind of illustrate the scale of the challenge and maybe the shifting goalposts. Dale mentioned that Secretary Bessent recently stated the U.S. economy needs to grow nominally by 7% every single year just to prevent the national debt to GDP ratio from getting any worse, just to stabilize it.
7% nominal growth just to keep the debt ratio steady. I mean, that sounds like a very, very high bar to clear consistently.
It is, yeah, especially when you think about typical growth rates and inflation targets. And Dale highlighted how the stated targets themselves have shifted. Secretary Bessent is now apparently targeting a 4% deficit to GDP ratio by the end of President Trump's potential next term.
Which is higher than previous targets.
Yes, it's a step back from the 3% target mentioned just last month, and it's a significant departure from earlier promises to, balance the budget entirely. Dale even referenced some earlier, perhaps less grounded ideas about finding $1 trillion in Doge savings or another trillion from tariff revenue to balance the books, contrasting those with the current higher 4% target.
And even that 4% target seems optimistic to Dale.
Yes, he doesn't really believe they'll get close to hitting 4%. He anticipates they might narrow the deficit from its current level, maybe around 7% of GDP, down to possibly 5-6%, or maybe optimistically 5% with the help of measures like Doge or tariffs.
But then what?
But then he foresees a potential one big ugly bill later on that could legislate significant spending increases, pushing the deficit right back up again. His core argument is just that the fiscal issue is enormous, and it's compounding, rapidly growing at approximately 12% per annum. That's a pace far outstripping the political will or ability to implement meaningful spending cuts.
That 12% compounding rate is really a stark reminder of the scale of this fiscal challenge.
Okay.
Let's bring this back to the Federal Reserve. They have a meeting coming up next week. This whole environment, conflicting economic signals, new geopolitical uncertainty, it must make their job even more complicated than usual.
It absolutely does. The prevailing view in the sources seems to be that the Fed is likely to remain in a wait-and-see mode at their upcoming meeting. As Michael Ringking put it, the recent conflict adds a little bit of uncertainty, but it's unlikely to cause them to change their immediate stance based solely on this one event.
However, that encouraging inflation data we discussed earlier,
Yeah.
those benign CPI and PPI readings, couldn't that potentially give the Fed some room to eventually consider cuts?
Yes, Ringking suggested that the positive inflation data this week might allow the Fed to highlight that the disinflationary process is already underway, potentially setting the stage for a rate cut later in the fall. He used a nice analogy, saying they might put the tablecloth down in July, indicating the possibility,
Okay.
and then the silverware and plates the actual cuts later on.
But the potential for an oil shock resulting from the Middle East conflict directly counters that positive inflation picture, doesn't it?
It's a huge complicating factor. As Ringking noted, a significant spike in oil prices would inevitably feed into inflation numbers, which the Fed simply cannot ignore. This could counteract those positive signals from the recent CPI and PPI data and make any near-term decision on cuts much, much harder.
Darius Dale's base case for future rate cuts, it seems slower than some might expect, even before this latest geopolitical uncertainty hit.
Yeah, his projection, which he ties pretty closely to the outlook for tariffs and future fiscal policy, is for roughly one rate cut in 2025.
Just one next year.
Yeah, and then maybe 1 to 2 additional cuts in 2026. A pretty slow path.
Mark Meldrum, though, looking at that benign inflation data before the full impact of the Middle East escalation was clear, he actually felt the Fed had a really clear opportunity to cut rates this week.
He was quite firm on this point. He believed that based on those benign inflation readings, the Fed had permission, as he put it, to cut rates by 25 basis points. He argued that it would be a big mistake for them not to.
What was his reasoning? Why cut now?
His reasoning was that a 25 basis point cut wouldn't significantly ease financial conditions at the restrictive long end of the yield curve. That's where monetary policy really transmits to the real economy. Instead, he argued, it would primarily serve to lower the government's own short-term borrowing costs on things like treasury bills and other money market instruments.
So in his view, it was kind of a low-risk opportunity to provide some relief, mainly to government finances, without really unleashing inflationary pressures or significantly stimulating the broader economy.
Precisely. However, he then quickly pivoted, acknowledging the new uncertainty from the Middle East. He stated that the Fed would likely use language emphasizing an abundance of caution. And critically, he said that if oil prices were to spike significantly before their meeting, pushing towards $80, $90 or even higher, then, quote, you're probably not going to get a cut at this meeting at all.
He also expressed a view on how this whole period might be remembered for this particular Fed committee, didn't he?
Yes, Meldrum believes that the moniker too late is going to stick with this Fed. He sees them as being late in initially raising rates when inflation was picking up, then not cutting last summer when he felt the data allowed for it, and now potentially holding off on cutting when inflation is showing signs of cooling, because they're facing these new geopolitical uncertainties they didn't anticipate. Kind of damned if you do, damned if you don't, but always behind the curve in his view.
Where does the market currently stand on anticipating Fed rate cuts? What are futures pricing in?
According to Mark Meldrum, the market is actually converging towards the Fed's own most recent projections from their Summary of Economic Projections, the SEP. The last SEP indicated 2 rate cuts for the year. And currently, the Fed funds futures market is implying roughly 2 cuts by the end of the fourth quarter. So market aligning with the Fed's last signal.
And a new SEP and a set of projections is coming very soon.
Yes, the updated SEP is due in just 3 days, June 18th. Meldrum considers this a big one because it really resets market expectations. He noted that if the new SEP still shows 2 cuts, the market will likely recenter around that.
But if it changes...
However, if it only prices in 1 cut, his personal ZQ futures position. Those are contracts tied to SOFR, tracking Fed rate expectations where he's long several contracts out into the future. While that position would likely be significantly underwater. It just highlights how closely investors are watching these Fed projections. They really matter for positioning.
Definitely a lot riding on that next step. Okay, quick plug. Subscribe to the Snippet Labs YouTube channel to stay updated on analysis like this. Let's now take a deeper dive into specific asset markets, starting with treasuries, because there seems to be a really significant disconnect happening here between the data on demand and the prevailing market narrative.
There absolutely is. It's quite puzzling. On the one hand, Michael Ring-King highlighted the importance of this week's U.S. Treasury auctions for both the 10-year and the 30-year bonds, which saw strong demand. Good auctions.
Okay.
He also pointed to data from Torsten Solak showing that foreign investors have actually reached a record high level of exposure to longer-dated U.S. Treasury markets, what we call duration. That indicates robust borrowing from overseas.
And Mark Meldrum used data from CME's Treasury Watch tool to really back up this idea of strong underlying demand, particularly for longer-term government debt.
Yes. He presented data showing really solid bid-to-cover ratios for the 30-year auction, averaging around 2.43 over the last 6 months. Bid to cover, that's just a measure of how much demand there is relative to the amount of bonds offered. A higher number means stronger demand.
And 2.43 is considered strong?
Yeah, well within historical norms. He explicitly stated that based on this data, there is no issue with bid to cover. The auctions are going just fine.
Okay, so the factual data shows strong demand, successful auctions, record foreign buying. Yet, as Rin-King noted earlier, Treasury yields were moving higher on a day when risk-off sentiment usually pushes them lower. What explains this apparent contradiction?
This is where Mark Meldrum makes a really compelling, if somewhat contrarian, case. He argues that the long end of the Treasury curve, represented by bonds like the 20-year and 30-year, and popular ETFs like TLT, which track them, is currently wrong.
Wrong. How so?
He believes yields on these long bonds should be much higher based on economic fundamentals and inflation dynamics. But they're being held down or maybe pushed around by a prevailing narrative in the market that suggests these assets are somehow undesirable or bad right now.
So it's not about a fundamental problem with the U.S. government's ability to pay its debt or a genuine lack of buyers, but more about market sentiment and positioning driving the price.
That's Meldrum's core argument. He sees this layer of traders who are primarily trading based on a narrative, maybe treasuries are bad, or perhaps those fears about the fiscal situation leading to higher yields eventually. And this narrative is currently overriding the actions of long-term investors who, based on the data like auction results and foreign buying, see the fundamentals as perfectly fine.
Hmm.
He contends that only the price of these long-term bonds is incorrect relative to those fundamentals. He points to other metrics too, like corporate bond spreads, specifically OAS, option-adjusted spreads, which measure the extra yield investors demand over treasuries for taking corporate credit risk.
And what do those spreads show?
They support his view that there isn't widespread credit stress or crisis brewing in the bond market. The exception, he notes, is some clear stress appearing in the riskiest part of the market, those CCC-rated high-yield bonds. Their spreads are like 40% above their low points, whereas spreads on higher-rated bonds are much tighter, only 10–17% above their lows. So stress is contained to the very bottom of the quality spectrum.
Okay, if the underlying demand is strong and the fundamentals look okay outside the riskiest credits, where is the pressure coming from that's pushing yields up? Or, perhaps more accurately, preventing bond prices from rising as much as they otherwise might?
Meldrum points directly to short interest on the long end of the curve, particularly in futures contracts and ETFs like TLT.
People betting against long-term bonds.
Exactly. He explains that primary dealers, the big banks that facilitate treasury auctions, are often net short the 20-year and 30-year contracts for various reasons. To hedge these short positions, they have to sell the underlying bonds, which creates this consistent selling pressure in the cash market.
Oh, okay.
He also notes that both retail and institutional investors are apparently also net short these long-duration instruments right now, all contributing to what he describes as a very crowded trade, meaning a lot of players are positioned betting on prices going down, yields going up. This positioning, largely based on that negative narrative, is what he believes is currently overpowering those underlying positive demand signals.
Okay, now here's where it gets really interesting, potentially. Mark Meldrum also sees a potentially massive tailwind for demand for these very same duration assets coming from a somewhat unexpected place. Stablecoins.
Yeah, this was a fascinating part of his analysis. He views stablecoins as potentially a big thing, something that could fundamentally change parts of the financial system.
Mm.
He sees them potentially being addressed in proposed legislation like the Genius Act he mentioned.
And he mentioned big companies getting involved.
Yes, he specifically mentioned major companies, household names like Walmart and Amazon, are actively looking into integrating stablecoins into their operations.
Why would companies like Walmart or Amazon be interested in using stablecoins? What's the appeal?
Meldrum explained a couple of reasons. One is potentially bypassing costly traditional payment card processing fees. But the bigger opportunity he highlighted is the potential for them to get the carry.
Get the carry. What does that mean?
It refers to the fact that stablecoins are typically backed by reserves often held in U.S. dollars or, more commonly now, short-term U.S. treasuries or similar cash equivalents. If companies issue their own stablecoins or even just facilitate payments using existing ones like USDC, they could end up holding significant balances of these backing assets, and they can earn interest that carry on those assets.
So companies could potentially become huge holders of treasury bills or money market funds simply as a byproduct of adopting stablecoins for payments.
Exactly. Meldrum argues that this mechanism will increase the demand for T-bills right away as stablecoin usage grows and scales up. He even believes this increased demand focused on the short-term government debt could potentially flatten the curve by pushing demand and yield dynamics outwards along the maturity spectrum over time.
And he sees this as potentially the most significant use case for cryptocurrency technology, more so than Bitcoin.
Yes, Meldrum explicitly stated that stablecoins are the killer app for crypto. He argued that Bitcoin, which he questioned earlier as just a risky bet, might not even survive in the long run. But stablecoins, in his view, make a hell of a lot of sense as a payment and value transfer mechanism. He sees them as a definite tailwind for demand for duration assets, contingent, of course, on the regulatory environment evolving, perhaps faster if legislation like that Genius Act gets passed.
That's a really thought-provoking angle on potential future demand for treasuries.
Mm-hmm.
Okay, let's shift gears and look at the stock market now. We've heard some talk recently that the market is broadening out, moving beyond just those mega-cap tech names that dominated everything for the last couple of years.
Richard Bernstein highlighted this trend in that Yahoo Finance Asking for a Trend segment. He noted that currently about 45% of the stocks in the S&P 500 index are actually outperforming the index itself this year.
And that's up significantly.
It is. It's a big increase from the roughly 30% seen in the past 2 years when the market's gains were so heavily concentrated in those MG7 mega-cap tech stocks.
So participation in the rally is definitely expanding across more companies.
Precisely. Bernstein also pointed out that more sectors are participating now. 7 out of the 11 S&P sectors are currently outperforming the overall index year to date. This suggests the market is becoming, as he put it, a lot more than just tech and big tech driving returns. Things are working elsewhere too.
Which sectors is he currently favoring in this broader market environment?
Interestingly, Bernstein mentioned he prefers utilities right now. He sees them as offering a more defensive characteristic, stable business models and providing attractive high dividend yields.
That's interesting because some strategists see utilities very differently now, right? As an AI play.
Exactly. His perspective actually contrasts with how some other strategists are viewing utilities not as defensive at all, but as an offensive infrastructure play, driven by that massive expected increase in power demand from AI data centers. It just highlights the different ways investors are looking at the very same sectors in this complex environment. Two totally different theses.
Were there any specific company highlights mentioned in the sources? Any individual stocks discussed?
Yeah, Hippo Insurance was featured following its recent investor day. The stock has actually performed pretty well, up about 10% year to date, and it gained 9% on the investor day itself.
What drove that?
Their CEO, Rick McCathon, discussed their new, quite ambitious targets for 2028. They're aiming to more than double their written premium to over $2 billion, quadruple their adjusted net income to over $125 million, and achieve an 18% or better return on equity. He emphasized the company's focus on discipline and also highlighted a new partnership with Baldwin that he said would triple their funnel for new home business. His core message to investors was basically, insurance is a longer-term business. Be patient.
Micron was also discussed, wasn't it, in the context of that broader push for domestic semiconductor manufacturing?
Yes, Christopher Miller, also via Yahoo Finance, mentioned Micron's really significant investment plans, totaling over $200 billion for R&D and manufacturing facilities right here in the U.S.
Wow, $200 billion.
Yeah, huge number. This initiative is seen as a major step towards achieving President Trump's goal of bringing semiconductor manufacturing back to the U.S. And it's expected to create approximately 90,000 jobs, both directly within Micron and indirectly through suppliers and supporting industries. Big economic impact potential.
Going back to the MAG7 for a second, Michael Ring-King noted a perspective that actually views these large tech stocks as almost defensive in the current environment.
It seems counterintuitive, doesn't it? But yes, he mentioned that some are seeing the MAG7 as potentially insulated from broader geopolitical risks, like the conflict in the Middle East.
What's the argument there?
The argument is that the demand for AI technology from these companies is just so strong and seemingly insatiable, as evidenced by solid numbers from companies like Oracle this week, that it provides a kind of cushion against uncertainty that might be affecting other sectors more directly. The AI demand transcends geopolitics, maybe.
Mark Meldrum, however, has a fundamentally different view on overall market beta, particularly for large caps, right? He's not buying that defensive angle.
Not at all. He argues that beta, that measure of a stock or portfolio's sensitivity to overall market movements, is basically wrong right now, particularly for large cap stocks. His personal positioning reflects this. He stated he is actively short large cap indexes like the S&P 500 using ETFs like SPY, and simultaneously long small cap indexes using ETFs like IWM, a classic pair trade based on that view.
And he used factor analysis to explain why he thinks large cap beta is wrong.
Yes, he presented data showing factor performance over different time periods. Over the last 3 years, only growth and momentum factors have significantly outperformed the S&P 500, while factors like small cap, value, and high dividend have badly underperformed.
And more recently?
Looking more recently, since what he called the Day of Liberation, a term he uses for a specific shift he saw in market dynamics, momentum has absolutely soared. Growth is still positive, but pretty much everything else is down. His takeaway from this factor performance is simple. Momentum works. The strategy of buying stocks that have already performed well continues to be rewarded, maybe excessively so.
He also analyzed some JP Morgan data to break down the S&P 500's performance, specifically looking at the contribution from the MG7 stocks.
Yeah, this data clearly showed how the very high earnings growth from just those MD7 stocks has been the primary driver pulling up the price of the overall S&P 500 index.
What about the rest of the index, the S&P 493?
Well, the S&P 500, excluding the MG7, has shown significantly lower earnings growth rates. He cited figures like 9%, then -4%, then 4%, then 7% in recent periods. Much, much lower growth. Yet, despite this far lower growth profile, the S&P x MG7 is trading at a very high forward earnings multiple, somewhere around 21 to 23 times expected earnings.
And he sees that valuation as a major red flag.
Absolutely. Given its much lower growth rate compared to the MAG7, he described the S&P x MD7 as really, really expensive at a 21-23x multiple. That results in a price-to-earnings growth PEG ratio over 3.
And over 1 is usually considered expensive.
Right, so over 3 suggests a significant premium is being paid for that slower growth. He questioned whether 21-23x earnings is somehow the new normal multiple for the broader market, or if a reversion back to a historical mean, maybe 17-18x earnings, is still possible. He likened the wait for this potential reversion to waiting for GDAU, apparently a notoriously long and frustrating process for market watchers waiting for something to happen.
Another data point he highlighted that typically signals headwinds for equities is the current level of real interest rates.
Yes, this is a really key piece of his overall argument that markets might be fundamentally wrong right now. He showed that real rates, the nominal interest rate minus inflation expectations, are currently very high. The real yield on the 30-year Treasury bond is the highest it's been since that specific bond was reissued back in 2010. And the real yield on the 10-year Treasury is back to levels last seen way back in 2008 or 2009.
And historically, high real rates like that are typically negative for stock valuations, aren't they?
Generally, yes. When the real cost of capital is high and inflation isn't providing a tailwind to nominal revenue growth, companies need to generate genuine economic growth to increase earnings. Plus, high real rates make the present value of future earnings lower. Basic finance theory.
Yeah.
Yet, as Meldrum notes, equities don't seem to care about these high real rates right now. He sees the market largely ignoring or maybe looking past the current economic and interest rate data, and instead pricing in expectations for earnings growth way out into 2026.
He finds this disconnect pretty troubling, I believe was the word used.
He does. He sees it as indicating that either the real rates are currently too high and need to come down, or the equity market is overvalued and needs to come down. He leans towards the view that both markets, the long end of the Treasury curve and the equity market, especially outside the MAG7, are currently mispriced, driven more by these narratives and positioning rather than by underlying fundamentals. Something has to give, basically.
We also heard some discussion about specific options trading strategies that traders can use in volatile markets like this, particularly from Sean McLaughlin.
Yeah, McLaughlin discussed strategies for navigating these volatility spikes. One example was selling put spreads when volatility increases significantly and the market starts to bounce after a sharp dip.
How does that work?
A put spread is a defined risk strategy.
Yeah.
You sell a put option at one strike price, and then you simultaneously buy a put option at a lower strike price, both in the same expiration month. This limits your potential loss to the difference between the strike prices, minus the premium you received for selling the spread.
And the goal.
He uses this strategy to bet on volatility contracting, coming back down from its spike, or maybe on the market holding recent lows. The key is it's done with a known maximum risk.
Mark Meldrum mentioned using similar tactical option strategies too, right?
Yes, Meldrum discussed using zero-day expiration options, those options that expire on the very same day they're traded tactically when he is shorting the market. He described rolling over these contracts, maybe on a weekly basis, primarily to collect premium. This can help manage the cost of holding his short position and potentially profit from very short-term price movements or volatility decay.
McLaughlin also provided a concrete example of a specific stock trade he's looking at right now.
He did. He highlighted Take-Two Interactive, the stock ticker TTWO. That's the video game publisher behind huge titles like Grand Theft Auto. He noted that the stop chart shows it consistently riding its 50-period moving average support level. And it recently tested that level and bounced back up nicely.
So he sees potential for it to move higher.
Yes. He sees potential for maybe a $20 to $30 move higher from current levels. His suggested strategy for playing this opportunity was a September call spread, buying the 250 strike calls and selling the 270 strike calls. He estimated this spread could be bought for around $5.50 to $6 per share.
Offering defined risk again.
Exactly. A defined risk profile, but with the potential for a nearly triple return if the stock reaches that target range by the September expiration date. Mark Meldrum chimed in, noting that finding these kinds of specific stock opportunities can often be more fruitful when overall market correlations are lower when stocks are moving more independently.
Okay, lots of tactical ideas there. Another quick reminder, drop a like and share if you find this kind of detailed analysis valuable.
Please do.
So pulling all of this together now, it's crystal clear we're looking at a market and an economy that's grappling with a significant number of contradictions and, frankly, conflicting signals from the data and the analysts we've heard from.
Absolutely. Let's just quickly revisit some of these core contradictions because they are so key to understanding the current environment. You've got potentially encouraging signals of disinflation, right? In measures like that supercore CPI and hints of labor market softening through rising, continuing jobless claims.
Which would normally point towards Fed cuts.
Exactly, but the Federal Reserve is facing these new pressures that might prevent them from cutting rates anytime soon. Primarily, that sudden spike in geopolitical risk in the Middle East and the potential for that to feed back into higher oil prices and subsequently push inflation back up.
Then you have the Treasury market, which seems to be telling two completely different stories at the same time.
Right. On one hand, the data shows strong underlying demand, successful auctions, record foreign buying, and maybe even this potential for massive new demand coming from the growth of stablecoins down the road.
But on the other hand,
Treasury yields are rising even in a supposed risk-off environment. And some analysts, like Dale, are pointing to a potential loss of safe haven status, driven by worries over the U.S. fiscal situation and clearly pressured by crowded short positioning based on a negative narrative. It's a real puzzle.
and another huge disconnect seems to be the relationship between interest rates and equity valuations.
Yeah, we have very high real interest rates, levels not seen in over a decade or more for longer maturities. Those are typically a negative for stock prices. Yet, the equity market seems largely unconcerned, just shrugging it off, trading at high valuations, especially outside the mega-cap tech names.
By pricing in earnings way out in the future.
Seemingly, yeah. Pricing in future earnings growth far out in time, ignoring the current rate environment.
We even saw a contradiction in how a single sector, utilities, is being viewed, simultaneously seen by some as a classic defensive high dividend play,
While others see it as an offensive growth sector, an infrastructure play driven by AI power demand. Total opposites.
and, of course, the sheer uncertainty in the oil market itself, with prognoses ranging from $40 all the way to $130 plus a barrel. That just reflects the immediate impact and the potential ripple effects of the Middle East conflict. Huge question mark there.
It really feels like in several crucial areas, these market narratives and the resulting positioning are exerting a powerful influence right now. Perhaps even challenging, or maybe just temporarily overriding, what the fundamental data or typical market behavior would suggest should be happening.
That's precisely the argument Mark Meldrum is making, isn't it? Particularly regarding the Treasury market. He sees this dominant narrative that Treasuries are bad, driving prices down or yields up, despite fundamental data like strong auction results and that potential stablecoin demand boost.
Exactly. And similarly, some of those challenging opinions we heard, like Meldrum's too late moniker for the Fed or Alex Morris's point about political pressure complicating the Fed's job, they suggest that external factors or perhaps just outdated analysis might be influencing decisions, potentially preventing the Fed from acting on those more benign inflation signals even before the geopolitical shock occurred. It hints that the Fed's hands might be tied by things other than just the raw economic data itself.
And just to be clear, throughout this deep dive, we've really aimed to present these different viewpoints, these data points, these analyses directly as they were presented in the sources you provided us.
Yes, that's crucial to reiterate. We are presenting this information factually, simply reflecting what is contained within that original source material. We are absolutely not endorsing any particular political stance, investment strategy, or individual viewpoint. Our goal is simply to give you an impartial overview of the ideas and data points being discussed,
Right.
so you can understand the various perspectives out there and navigate this complex information landscape yourself.
Okay, very important. And one more reminder, subscribe to the Snippet Labs YouTube channel for more deep dives like this.
Please do.
So, wrapping this all up, what does all this complexity, all these conflicting signals, what does it really mean for you, the listener, as you try to make sense of the current financial environment?
Well, I think it means we are undeniably in a period defined by powerful, often opposing cross-currents. You have underlying economic data hinting at disinflation and maybe a cooling labor market, which would typically suggest easier monetary policy is on the
I love
horizon.
that.
But this is being sharply countered by that escalating geopolitical risk in the Middle East,
Yeah.
with the very real potential for significant impacts on energy prices and, therefore, the Federal Reserve, a whole calculus on inflation and rates.
And we see strong fundamental demand signals for safe assets like treasuries, maybe even boosted by new tech like stablecoins.
Yet the market pricing seems heavily influenced by positioning and negative narratives, leading to those atypical yield movements we discussed. It's confusing.
The stock market appears to be broadening out, which is usually seen as a positive sign for market health.
But serious concerns remain about valuations, particularly outside those largest tech names, and whether current prices can really be sustained, especially given the backdrop of those stubbornly high real interest rates. And then, looming over everything, is that potential for a significant deflationary wave down the road, driven by AI's impact on productivity and jobs. That's a huge unknown.
Alex Morris, among others in the sources, emphasized that this kind of mixed and uncertain environment really calls for a degree of caution from investors.
Yes, he specifically advised against taking outside risk or employing high levels of leverage in this kind of market. The general recommendation seems to be to stick to your established long-term asset allocation and really focus on understanding the complex dynamic forces that are interacting right now. Don't make big, sudden bets.
Darius Dale reinforced this by saying that in such an environment, relying solely on your, quote, puny human brain isn't sufficient. You really need to employ proven risk management strategies.
Yeah, this period truly highlights how quickly market dynamics can shift based on unexpected geopolitical events, or perhaps when prevailing market narratives finally collide with underlying fundamentals or new technological forces. Things can change fast.
So the ongoing situation in the Middle East, any actions taken regarding U.S. trade policy and tariffs, and of course the Federal Reserve's upcoming decisions and their updated projections in that dishi. Those are clearly the key developments to watch.
They really are the major catalysts right now. Their outcomes could either start to clarify this confusing picture or potentially make it even more complex in the near term.
Definitely need to stay tuned. And one last reminder, follow us on Twitter at Snippet Labs for more updates as these stories unfold.
Good call.
So, pulling from the many perspectives we've explored today, particularly some of Mark Meldrum's analysis regarding market positioning versus fundamentals, here's a final provocative thought for you to consider as you process everything we've discussed.
Okay, let's hear it.
Given this confluence of factors, we've laid out the potential for a really significant AI-driven deflationary wave that maybe hasn't fully hit the data yet. The strong underlying demand signals for duration assets like treasuries, which could be amplified significantly by stablecoins, and the compelling argument that both the equity market's current valuation and the long end of the treasury curve are currently wrong, driven more by narratives and crowded positioning than by fundamentals.
Okay.
Are we potentially on the cusp of a major market correction? Not just one that hits the obviously overvalued assets, but maybe one that actually corrects both the overvalued areas and the undervalued ones simultaneously. Perhaps triggered when these underlying fundamentals and new realities finally overpower the powerful narratives that seem to have been dominating price action for so long.
A great reset, perhaps, where both sides of that perceived mispricing snap back towards reality.
Exactly. Something for you to think about. Markets move fast. Pinpoint your next profit window and seize the moment.